James Dainard, and we are back on the market update. Um, hey, so guys, today we're going to run through the market update, 30 minutes, kind of go through the same stats and data points that we've been paying attention to for the last 6 months or so. And then we are going to be jumping into live questions. So 30 minutes presentation, 30 minutes of questions, whatever you guys want about the market update. You just want to go into that chat box and ask the question. Or you can ask them throughout the presentation as well. So we're going to get going on this. Real quick, thanks to our sponsors, Intrust Funding, local hard money lender in Washington State. If you guys are doing deals and not funding your deals with us, definitely give us a ring. We make it very, very easy. No appraisals, quick funding. And then also EasyButton leads for anybody out there that is working at cold calling or needs to generate more seller leads. Definitely look them out. EasyButtonLeads.com. They are a professional dialing service that can generate leads for listings, off-market sellers, full scripted quality control calling, so you can build out your business. So real quick about me, for those who don't know me or somewhat know me, I've been a full-time investor since 2006. Myself and Will Heaton, my business partner, are kind of known as the recession flippers for investors. We flipped hundreds of homes through 2008 to 2010, where not a lot of people wanted to do it. It was a very tricky market to do it in. It was declining. We had to pivot constantly, but we were able to rack a return. So this market kind of shift hasn't been as bad as kind of operating during that time. Since then, we've flipped and been involved in over 2,000 homes, and we've done over 3,500 transactions with investors. With over $1 billion in sales. So very active investment shop. If you guys are not clients of Heaton Dainard, definitely come check us out. We had a really cool cash flow class last night. It was packed. And we kind of go over our business, how we underwrite deals, how we package them, and then really figuring out how we're mitigating risk into this next market. So for today, what we're going to cover is we're going to do we're going to cover January of 2023, what happened last month. Because the market's a little irrational, we're going month by month. So what's the variance? What do we see? The more trends that we watch, the better we can forecast. And so we're going to go through the tri-counties, which are King, Snohomish, and Pierce County. That is the main core areas that we are operating in. We're going to talk about interest rates, inflation, and just investment trends that we're focused on as a brokerage with our clients, and kind of where the best opportunities are. So 2000 or to go over what's happened in January. So Washington State, what does this look like? So the average median home price right now is at 655. At the high of 2022 was at 655,000. Currently, we're at 551,200, which is a 1.7 year over year decline. So we did see a decline from last year, January, but that all makes sense, right? Like last spring, January, February, March, April were crazy months, especially March and April. When we go into those months, we're going to see a lot bigger delta because the pricing just went through the roof. There's 31.6% more homes for sale today than there was a year ago. And the percentage of homes selling under list are at 19.2%, which is a 30% decline year over year. So we've seen about 20% of homes are not selling for full list price right now. That does also not factor in price drops because, if someone does an aggressive price drop and they get a full price offer, it's still at list price then at that point. So that's not from original. So we've just seen this kind of compression, and what we've really seen is that home sales are kind of down 20% from peak, and now they're kind of selling off. We'll talk about that more in a minute. We've seen a lot of market activity pick up in the last 10 to 14 days. And then average days on market are 37 days, which are up 24 days year over year. So it's taking longer to sell them. We're seeing that in our dispositions, but inventory is still getting moved. 2002 summary for this last month in 2000 or in January. Sorry, I forgot to update the top part of that. I'm sorry. King County median home sale price is at 729,000, and so that's been staying pretty steady to where we saw last month and the month before. So we're kind of leveling off. That is a 3.1% drop year over year in January. So if you're getting prepped to sell your property that you maybe bought at the beginning of 2022, it could have been a long renovation, anticipate there's going to be at least a 3 to 5% drop on your pricing. off peak pricing, we're still seeing quite a bit less. And so the median's more in the middle. So if you're looking on those flipper development deals, they might be more around 5 to 10% below your pro forma from where you were at in January. Pierce County median home price is at 499,000. That's down 3.1% since and Snohomish County is at a median home price of 660, which is down 2.9% from the end of December as well. So we're still seeing a little bit of a decline. And I feel like this last 3 months, or that last 3 months of 2022, we really saw a kind of a flattened, very low transactional market. Part of that is because there's always seasons to sell. And what happened during the pandemic and all the money getting infused in the market is those seasons, the seasonal slowdown in the fall and the winter, they kind of went away. There was so many buyers locked in with low money that homes are still transacting very quickly in the December months, which that's not typically normal. And so we're kind of getting back to normal as far as transaction goes. I was not concerned that much during December. We did very few price cuts the last 6 weeks of the year, partially because the showing activity was slow across the board. So we knew it was better to hold tight and wait for that buyers to come in. And we're seeing those come in now. So in Washington State, home prices were down 1.7% year over year. And at this time, home sales have fallen 45% year over year as well. And so what that means is there's just a lot less transactions going on. I will be really curious to see what the data points in February are, though, because we've definitely been transacting about 20 to 25% more in the last 2 weeks. Median home price is down to 551, and then days on market on average are up 284% at 37 days. And you guys, 37 days is still a pretty healthy days on market. 5 is not, and that's where we're seeing that very, very rapid appreciation. But technically, homes typically sell 65 to 90 days on market, kind of in that range, in a normal market or a flat market, or even this market that buyers are a little bit spooked. So the fact that we're at 37 is actually a healthy thing for considering how high rates are. And the mindset of consumers out there, how they're a little confused on what's going to happen over the next 12 months. And so the fact that it's kind of trending at that 35 to 40 day mark is a good thing. That's been pretty stable for the last 3 to 4 months. So as long as you know your price well, you get it on, it just takes that month or two to sell that property. And then we've seen a 200% increase in year over year supply. But again, that puts us at like less than 3 months worth of inventory in the market. It's still a very healthy market to operate in. I do feel like we've seen a lot of the compression from the rapid rate hike. And now because the Fed is doing quarter point hikes, it's being a lot more stable at this point. So King County, year over year inventory, similar to Washington, up 226%. December median home price was at 729. So that is staying a little bit more stable with where they are right now. So we haven't seen much of a dip from December to now. Numbers of sales decreased 44% year over year. And then days on market are up 25 days at 32. So King County's trending a little bit better than statewide. And then percentage of list is at 2.1% of all listed homes are selling on average 2% less than list price. And so when you're pricing things, especially in your more expensive markets, you want to kind of keep that in mind. Look at your days on market, look at where you're listed at. Do you feel good about the comparables? And just because you're cutting price rapidly doesn't mean you're going to get that full price offer unless it's a really good buy. And so in my opinion, in these more expensive markets, stay away from minimum price drops. It just doesn't, you're giving away money because the buyer could be coming in lower anyways, just on a negotiating factor. And so by pushing back and keeping your price a little higher, it gives you some flexibility in how you can negotiate. But don't be overpriced. If you're not getting showings, drop the price down. And then 61% of all homes sold under asking price in the last 30 days. So again, that goes into the negotiating factor, knowing your price, owning it, and then staying steady. Because if you're going to have to give a little bit off your price, you don't want to cut price and then give it later. So kind of think all those things through, talk to your brokers, get the feedback, track your showings. Are you getting enough showings? If you're getting enough showings, you will get that property sold. Um, so Pierce County, median home price is at 499,950. That's a 3% roughly drop year over year. In May, it was at 575. So we've seen a rather big drop from May to now. That's almost 20%. Inventory is up 275% year over year. So Pierce County's inventory is creeping even a little faster. Numbers of sales decreased at 50%. So that's why we're seeing the year over year inventory increase, is because Pierce County's transacting 6% less houses than King County on average. And then days on market are up to 40 days. So that's slightly above the Washington average. And then percentage of list, we're seeing 7.9% off list price. And I think that one of the main reasons is sellers are a lot more. I mean, if you think about this, in King County, if you're selling a home for $1 million, if they're 7.9% off, that's $79,000. That's a big number. But if you're selling a house for $300,000, that's roughly around what is that? That's $21,000. So I think it's more of a mindset thing and what people will kind of let go. So percentage of list is 7.9. In addition to a lot of buyers down in Pierce County, you want closing costs paid, and that kind of considered as well in there. Snohomish County median home price is at 661. That's a 2.7% year over year drop. In May last year, it was at 790. So again, and the reason I reference this last spring market so much is, on average, a lot of our flips take 5 to 7 months to get from start to finish. But our bigger fixtures usually take 9 to 12 months with our clients and ourselves. And so if we bought that deal 12 months ago, we still need to be looking at our pro forma. And if our pro forma is way off, which it very well could be, you still got to know what your house is worth, and you got to sell it accordingly or keep it. And so don't get trapped on that pro forma number. Make sure that you're pricing it to sell. That is expensive. You don't want to be sitting on market too long. Inventory is up 275%. Numbers of sales decreased 42%. And the days on market are at 31 days. That's up 25 days year over year. So all three counties went from an average of 5 to 7 days to all above 30 days in Pierce County at 40. So that's just the new trend in our Tri-County. And then percentage of list price, same type thing, 7.9% off a list. And I think that's because a lot of people also, I've noticed in Snohomish County, were just pricing higher. And there's certain markets that have compressed quite a bit, and people were hanging on to the price. We did on a couple where we sat on market for 100 days, but we ended up getting a little closer to list price than the 7%. So when you're looking at doing price drops, you're looking at making adjustments, really dig into those comparables. And if everything looks fine and you're getting enough showing activity, stay strong. So our listings, the average showings are, for some reason this didn't save right. I'm sorry. Average showings actually are now up to about 4 to 5 a week on our showings right now. We're seeing a huge uptick. There was actually a property that we had for sale in the east side, and we were getting an average of 2 a week. The last weekend we had 19 people come through. And we've been on market for over 90 days owning that price because we know we're priced well. We're a low price per square foot. We just got to find that right buyer. So the activity has surged recently in the last 2 weeks. January, not so much. It was still pretty slow up into that first 3 weeks of getting going. But currently we've seen an uptick of around 4 to 5% or 4 to 5 buyers a day. But that is, if you really think about it, that's a huge increase from a month ago where we're getting 2 to 3. That's almost 100% more people are coming through these houses, even though it's not as many bodies as we're used to. Right now, we went from being 37%, or in January, we were 37% pending. But right now, we're pending at over 60% of our listings pending. In these last 2 weeks, we've seen a lot of transactions and mutuals go down. Average days on market for us is around 50 days. So we're about 10 days higher than the average statewide in all counties. The reason being is we are selling product that is perfected. It's either had a full renovation or it's been cleaned up. We've also, our development sites that we're selling off, our new townhomes, they're on the upper echelon because they're the upper echelon product. And when there's an affordability issue, those ones are going to take longer to sell. And so as you're pricing that next dispo, remember, it's okay if you don't get an offer in 2 weeks. A lot of people are trending in this when you're at the higher echelon. The median price and what we saw across the board, that's going off median numbers, and the low end stuff is selling fairly quickly. So when you blend it all together, it's going to make it look like the days on market a little bit down. So depending on your product, if you're concerned about your days on market, don't go off the general. Have your broker pull what's the price point in area and what the average days on market are in that area of where you're selling in. That will make you more logical as a seller at that point. Another deal that we did, we were on market for 110 days. That was in Bellevue, and we kept getting low offers for months, and then we just hung tight, and then we just contracted the deal for about 2.5% off list, and it closes in about 3 weeks. But because we knew our data points, we didn't cut price. And we knew what the product that we had was. If the comps would have been reflecting less and we were in a less desirable area, we would have adjusted much quicker. So know your comps, know your averages. We also saw in the 1.5 to $2 million range in the specific area, it was taking 60, 70 days to sell these houses. So we weren't too concerned with how many days we were on. So keep tracking on those. And then right now we're still trending about 5% off list off of our product. And it really also comes down to who's the seller, how quickly do they want to get that deal done, and whether we are, how hard they want us to negotiate at that point. But, if you're listing something and if it's priced in an area where there's a lot of traction, might sell really quick. If you have a little bit more active, a little bit more green dots in your map, then you're going to have a little bit, lower offers at that point. There was another one in Mountain Lake Terrace we just sold. We listed at 880, got sold it for 880. And because it was priced well and there was zero inventory in the market, we got that full price offer. So really check your actives. What's your competition? Oh man. I think, sorry guys, we're a little bit off. For some reason this didn't report save either. So inflation rate fell again December. It fell. So in December it was at 6.5. In January we were actually at 6.4, and at 6.4 that put us at, that was inflation rate. Sorry guys, because I didn't save up, I didn't have my stat with me. So it has came down, and we've been seeing a slowly slight tick down. The biggest and the best news out of this is it came in lower than expected. And what we want to see is if the Fed is seeing results in their predictions, or it's coming in lower, because what was happening why they're racking the rates up so high is they would predict, and then the inflation will blow way past that prediction. And that caused those half quarter, 3-point hikes that were really aggressive. They kind of shocked our market. Now they're down to quarter-point hikes. The reason being is they've already raised them rapidly, and then also they're seeing some ease in the market. And the fact that it's not good that it's up 6.4%, but it is good it's coming below their predictions. So it has definite signs of slowing going on. All right. Ooh. Sorry, guys. I think we might have uploaded the wrong presentation. It's okay because I remember these numbers. So interest rate review. We currently where our rates are at. Right now, rates are trending around 6.25 to 6.75. We have seen a slight uptick over the last 7 days. The rates have actually gone up 11 basis points over the last 7 days, and the 30-year fixed refinance rate is averaging at 6.78. So we did see rates drop down a little bit, and I think that's where we saw a surge of activity. If you're pricing things right now, there is buyers still locked in a little bit lower. Make sure you're making it attractive to people who want to pull that trigger, because we're starting to see a kind of creep back up again. Partially that's because the Fed did announce that another quarter-point hike. So every time they come out, there's going to be a little bit of adjustment. But with loan volume and where the Treasury yield at, it's kind of staying in that. I'm hoping in the next month or two, we're kind of in that low sixes. So again, the averages right now are 30-year average is 6.67. The refinance rate is 6.78. For an investors, it's about a point higher than that. So if you're underwriting your next rental property, look at 7.5 to 7.75. It's really important to be talking to your mortgage professionals right now and getting the current rates and where they think they're going to be by the time you stabilized. If you're buying a burr property or you're doing a fix and flip, the rates today do matter. But if they're going to maybe be lower by the time you dispo that or refinance it, it's going to improve the deal. If they're going to be higher, it could cause issues with your deal. So talk to these mortgage professionals, find out where they think they're forecasting, and kind of go from there. Current Fed rate is at 4.5 to 4.75. It's the highest it's been in 15 years. And then the Treasury yield has gone. It was at 3.55% last month. It is up to 3.71% right now. So it is starting to move just a little bit. And you want to pay attention to that Treasury bond. That also affects the rate on interest rates. So if we stay in that kind of mid threes, we should be okay. We'd like to see it kind of a little bit lower than that. But once we start creeping above 4, that's a bad sign. So keep your eyes on that as well. And then one more thing, and we talked about this last time, is Freddie Mac is forecasting the average 30-year mortgage rate to start at 6.6 in Q1. And by Q4, they think it's going to end at 6.2. So they are predicting that we're going to kind of stay steady and have a slow decline towards the end of Q4. I've also heard a lot of other people predicting high fives. So if that's the case, there's a deal that we just bought, or I think we're committing to right now. It's a raw piece of land. It's a great price. We got to develop the whole thing. This is a 2-year deal, but we're actually happier that instead of making it a quick one, we actually might be timing it right to where rates could be in the high fives by then. And in theory, we could get some lift. So think about all those things while you're underwriting your deals. So what's the impact from interest rates? I think anybody who sold a home recently is feeling this. Longer market times, right? We've seen the averages jump from 5 days to 30 days plus. We're still seeing a little bit of irrational price drops where, if someone's not getting the showings, they cut price heavy. And when you're dispoing out a deal there, that can be tough, right? If the people are dropping aggressively underneath you, it doesn't, doesn't help the cause. Actually, I just saw that recently. We were comping out a house over in Bellevue. There was a house that was on market during December at $2 million. They cut price $250,000 in January because they probably weren't getting many hits. It then took it went down to 1.7, and then they sold it for around list price. Another home within walking distance that basically had the same finishes listed 5 days ago, and it sold full price at 199. So don't cut these massive price drops unless you know it's going to have impact. Cutting price just to cut price does not always work. But if you're not getting showings, definitely cut the price. But by paying attention to those data points, it can kind of calm you down. If you're a broker and you have clients, go through these data points with them. If you're an investor and you're selling things and you're kind of trying to figure out why your broker's not moving the deal, have them go through these. If you're running with the averages, that means you're doing the right plan. And so just check on those. Buyers are still being very selective. They're also being a little bit of fear mongering, I've noticed, especially in certain neighborhoods. The brokers are calling me off. They're referencing the tech layoffs. Like, the tech layoffs are here. People that aren't buying, the market's going to crash. It's almost like a fear-based offer. And that's okay. They have a right to negotiate whatever they want, how they want to do it. But really think about it logically too sometimes. Like I was talking to one broker. She's like, well, there's a lot of layoffs. And I'm like, yeah, I've read up on that. I kind of looked at where the segment is. And the people that got laid off in this sector are really not affecting what we're selling. It's a lower price point at that point. It should be like 900 and below for those buyers. We were at the 1.5 number, which is, it was keeping the demographics of who was not laid off kind of still in the hunt. So they're more sitting on the sidelines. They're just not, but they're still there. So if you're patient, they'll get off and buy your deal. And then showings have reduced 90% in the last I'm sorry, this one didn't make it too. So showings, we've actually seen an increase. I do want to point this out. They were pretty steady December, January. The last 12 days, we've probably seen an increase of 90% in showings on a lot of our properties. There's more bodies in the market. People are looking again. And so make sure you price it right, make sure it's buttoned up, and you will get that transaction. All right, so our current strategy, and then we're going to kind of open it up for questions. We're just about the 30-minute mark. So again, what we're doing, underwriting, we have to account for these longer holding times. We're adding 2 months of hold into each one of our deals to account for the hard money cost. Cost of money really only hurts when you don't have the right timelines in there. The rest of it's absorbed in your pro forma. So make sure that you have the right hold times in there for your processes. We're still adding 5 to 10% construction contingencies in all of our budgets. Cosmetics are more 5, bigger fixtures are at 10. Still using cluster comps, no outlaying high comp. We're not using those. Not unless it has some unique features that we have, or if the rest of them are dated and the one is really dialed in. But we're staying with the masses. And then this says recent 60-day sales. For the past, we've been really, really disciplined on pulling comps 60 days back. What we've done in the last 2 weeks is we are going all the way back now to August, because as long as the rates are +6, we're using those data points. And so we're basing our time frames based more on where rates were. In August, it was pretty ugly on rates. So we're going back to those times because it was kind of this slow. The market was shocked. I actually feel like the market's healthier than it was back in August. And so if we're using those data points, I actually feel pretty good about it. So don't just use any set of comps. Use the like for like comps, same bed, same bath, same locations, but also look at the time frames they're being sold in. And then we're putting a heavy emphasis on pendies and actives. We want to know where things are transacting, where the buyers are, and then we're trying to focus on buying on those areas. Our increased returns for fix and flip, we were at 12 to 15. Now we're at 15 to 19, which equates out to about a 40 to 50% return with leverage. So we've increased our returns. Single family underwriting. Again, we're still there. We are increasing our margins by 10% on when you're using leverage. We want people with bigger walk-in margins to deal with any kind of issue. Development, there is massive opportunity in land right now. There's permanent sites floating around. There's raw land is fairly cheap because builders don't want to be in a 2-year deal right now. In addition to, there's some really good buys on raw land because the takedown financing that builders could get where the rates were a lot lower at the beginning of 2022. I know we were getting construction financing for like 6.5%. Now that's 9 to 10%. And so people don't want to hold that raw lot for that long and pay that kind of interest. It's a cash flow suck. And so there's a lot of opportunity. If you're sitting liquid, you're sitting on an IRA, you're sitting on something where you can snatch a land value for quite a bit less. Multifamily, we're seeing some opportunity there. We still haven't seen what we were hoping we were going to see. There is low transactions going on. Those peak values have definitely came down 15 to 20% from, or I'd say 10 to 20%, depending on what the product is. Maybe fourplexes in South King County that were trading for $950 are now in kind of more of the high 8s. But we're not seeing those really good buys that really help with the interest rate hikes. And so we're still searching. There's still opportunities there. It's just not as many as we would think. So things are kind of staying steady. And then in the larger projects, the 40 to 80, we've definitely seen some increased inventory. So if you're looking for a bigger apartment building, there's actually better buys in that section. So forecasting for the rest of this quarter, we are thinking it's going to be slow to stable in the first quarter. The last 2 weeks have made me feel a lot better that we're seeing transactions going on. We're getting offers. And not only that, we're seeing a lot of showings in general. And so that means there's buyers. If I'm getting 20 showings in a week today, and there's 2 homes for sale in that area, those buyers are going to be hanging around. These are people that want to own property. So the first quarter in the spring market could be better than we're all anticipating. The inventory is still really, really low in areas. People want to buy houses. I do feel like the rapid rate increases have caused the market to stabilize out, and people are starting to realize that, and more transactions are going on. So I think slower to good first quarter. Second quarter, I think it's going to be a little bit more normal in transactions. We're not going to see the crazy bid up amounts, but we're going to see more deals going down. So I was up late at our cash flow class, and I was up early for a podcast this morning. So I'm a little yawny today. Rates will most likely drop quarter 4, depending on the inflation in job reports. That's what Fannie Mae is predicting. That's what a lot of economists are predicting, that we're going to be high 5s, low 6s by the end of Q4. We're thinking rents are going to still flatten out. We do think that rents in the higher end market, where you're that 4 or 5,000, 3,500 to $5,000 rents could come down a little bit. That base hit blue collar market seems to be leasing fine. I know we're running at like 96% occupied on our available units, so everything's kind of staying full. And then we're also thinking that there is still going to be some opportunities out there on the more complex sites. If you're looking for those base hit, solid, quick cosmetic deals, people want those as well. So you have to be prepared to be a little bit slimmer margin. If you want those bigger fixers, as construction still is kind of a kink, you can get more opportunities there. So forecasting the investments, it's still a seller's market right now. You just need to be patient. Inventory is still well below where it should be to be healthy. There is some opportunities increasing right now. We are seeing them. They're in different spaces. Heavy fixers. If you have a construction background, we can get you a really good deal. The harder the project, the better the return's been, and that's always how it's been. The only reason we saw these tight margins on big fixers before is because it just became normal. That's not how this business typically works. If you have to do more work, you should make more money. So there's better deals there. And then we've seen, we've already kind of hammered through a lot of these other ones. Another thing that didn't make it on the slide was there's a huge opportunity that we're seeing that we're tracking, and that's based on the house with Dadoos in the back. Those numbers are looking really, really good. And at Heaton Dainard, we're working on packaging some of this stuff up for our clients. In addition to, if you have a demand for rental properties and you want to buy, build, and cash flow out, we're sourcing a lot of sites like that as well. So if you have that interest, come check us out. Follow us on social media. Instagram, we're at Heaton Dainard, or myself at JDaneFlips. Also check out our YouTube channel at Project RE. These are all going to give you free advice, free tips, construction tips, forecasting tips. And also don't forget to check out the Bigger Pockets on the Market podcast that we're on. That's all we're doing is looking at opportunities and forecasting. We had a great speaker today from Fundrise on there, and he was breaking down ways that they predict how to invest in certain markets and assumptions they use to really make sure that they're safe, but also still making a return. So a great thing to be checking out. And with that, I'm going to open up the presentation for all those who have questions. So if you have any questions, please put it in the chat box right there. And then for those, and we will answer these questions until they're all wrapped up. And I know people have to have questions because I was at the cash flow class till 11 o'clock last night answering questions. So if you have any, fire them in the box, and then we'll go from there. All right. Peter Miller says, big fan of yours ever since finding you on Bigger Pockets. Oh, thanks, Peter. I appreciate that. We are just deal guys and brokers. So, that's, I'm glad people are liking what we're putting out there. Again, for us, how we built our whole business was about helping people mitigate risk and helping them walk into that first flip back when the market was bad in 2008, 9, 10. And the cool thing about social media now is we can help people mitigate risk on a big platform and just teach. And so that's something that our companies are all very passionate about, educating that investor, helping them grow. So stay tuned. We'll keep doing it. Another question. Alex Springer says, how are you seeing cap rates? A good question. How are you seeing cap rates for multifamily respond to higher interest rates? We've gotten some fairly good ones recently. I know we closed 2 where we locked in debt around 6% on them, and then our cap rate stabilized. We're going to be about a 7 to 7.5% stabilized on pretty conservative numbers. And so we've seen them all improve on the large multifamily side. The 2 to 4, people are still buying on loan to value positions, and they're using more of those metrics. They're not really concerned about cap rates. So there is better buys. If you are selling a multifamily, you should expect a little bit less right now. Or if it's fully stabilized and kind of maxed out, you're going to get a decent cap, but they're still going to need to be a little bit of flex in that price to cover the debt cost. Right now, I would say if you're planning on selling multis, do it because you have a purpose. Like I have one up for sale right now. If I get my number, I'll go 1031 exchange it, upleg it, and get more units. if I don't get my number, I'm just leaving it alone because I'm locked in at a low rate. My cash flow is good. And so I would say sell the multis that don't work well in your portfolio. And it will be a trade-off, right? Like, because if I sell my duplex for a decent price, but I can go get a better price and add value, it's still a smart trade. So look at the full picture. Don't just look at rates. Don't look at your price. Look at on the multifamily 1031 exchanging. Are you improving your position? Doesn't matter about rates and everything else. If you're improving your equity position, you're improving your cash flow. It doesn't matter what you're selling your asset for. Um, and so, or at least that's my opinion. So just kind of stay focused on that. But we definitely have seen an improvement on those. Any more questions, guys? I mean, the good news is we have had, I mean, the last 2 weeks have been kind of, it feels better for sure. You know, as brokers, we've been really grinding the phones and working the sale. You know, I think a lot of brokers out there, you know, we got used to systems and being on market through channels, the offers roll in. We're just back to the basics, pounding the phones, finding the objections. Are they solvable? Bringing that offer in, and communicating. If you don't communicate, it's hard to get an offer right now. Tyler Sager says, "Are you seeing any turnkey rentals in this market, or is it mostly value add properties?" Kind of depends. Actually, we saw a really good one that we're working on right now. It was like a 2000 built house. They needed carpet paint. It was definitely rough with the tenants, but it's a very simple turn. And now you had to leave liquidity in there, but if you put 20% down on this property, the cash on cash return was going to be 12.5% for a really quick deal. And not only that, there was about a 5 to 10, there's about a 10% discount. So on that property, it was worth roughly about 475,000 to 500 grand. So by buying this deal, I was leaving 20% in, or our client's going to leave 20% in. You know, so it was requiring to leave about 75 grand in the deal, but they're making 11 to 12% on that money. Or no, I'm sorry, that was wrong. They were making 7% today. If rates drop down to high fives over a 2-year basis, the return went to 12 to 13%, and they picked up a 50 to 60K equity kicker. That's a good deal, right? Like if someone was telling me about that deal 18 months ago, I'd have bought it all day long. And so these are things, just look at the big pictures. So we have seen some of those where we're seeing a lot of more, the value add is, we're definitely seeing better buys. If you're looking for the burrs, target those heavy fixers. You're not going to get your cash flow for a year, but at the same time, the discounts are there. So I would say the ones in the middle are kind of more the tougher ones. You know, like where they're beat up, where you have to put a lot of construction or a mediocre amount of construction in, but the pricing is not quite there. The cosmetic true turns, we've seen a little bit better action on those. All good questions so far. Got any more questions, guys? Sometimes they're firing off and sometimes they're not. Maybe you guys all got the yawns like me. Other things that we're seeing too, as I'll kind of wait for see if any more trickle in. We're having for people that are trying to blind market, yeah, we're having really good luck with these call rooms right now. So if you are trying to generate leads, reach out. We can get you kind of paired up with them. Or wholesalers out there too. If you're having problems transacting your deals, definitely reach out to us. We'll get you numbers before you go to your appointment. So I think if you want to do well in this market, you just got to look at the big picture and then build those relationships and see what relationships you can develop together as a team. And it's been helpful getting more deals done for sure too. Okay, guys. Well, about last call for questions, and then we're going to wrap it up. That was an easy one. I got an extra 20 minutes to get some more work done. Okay, well, you guys be on the lookout for emails from us. We're doing a couple on-site walkthroughs right now, or not right now, but in the very near future, we're going to do a tour of our luxury flip that we just listed out in Redmond, Washington. Really cool farmhouse house. We're going to talk about how we upgraded it, why we upgraded it in those ways. We're going to be doing a walkthrough on the finished hoarder's house for all those who came to our hoarders walkthrough. So be on the lookout for that. That's wrapping up in about 10 days. And then we're going to be doing a rough-in walk-in too, where we're going to have the property completely wired, framed, plumbed, ready to go. And as we call them for our insulation inspection, we'll bring everybody out. We'll talk about the problems we had, things we learned, and then ways we were able to pick up costs out there as well. So be on the lookout for that. And then next month, we will be recapping February. I'm anticipating the numbers might be a little better. So make sure you tune in for that. And we hope to see you guys soon at our one-on-one class, or our clients reach out to our brokers and we see what we got for